Good day. Today I want to talk about the topic of my trading philosophy and my trading approach because I've looked at the statistics, and the failure rate for retail traders who fail at trading forex is extremely high. So most people who trade forex lose money over the long run. Most retail traders do not make money. The statistic is like 96% just do not make money at all. And the small majority who do make money, it's not a lot. And then you have just a tiny bit, less than 1%, who actually make substantial amount of money from the forex markets. So in this video, I want to talk to you guys about an edge that I have developed in the forex market, my approach, my philosophy, and how I approach the foreign exchange markets, and why I think if more people approach the forex markets like this, the failure rate, in my opinion, would be a lot lower. So that will be the discussion of this video today. I'll talk about my trading approach and philosophy, which has made me a profitable trader, and why I think most retail traders fail. So first of all, we're going to head to TradingView right here, which most retail traders use, and it's the only thing most retail traders focus on. They look at technicals. So most retail traders, they look at these candlesticks and they say this candlestick move here, so that means that institutional money is bullish and this and that and whatever. And technicals are important. You can become a profitable trader using purely technicals, but it is much more difficult, and that's not an opinion, that's a fact. And the reason why that's a fact is because technicals aren't the only things that drive price. So when you focus only on technicals, you're essentially ignoring macro, sentiment, positioning, interest rate. You're essentially ignoring all the other factors that drive markets when you focus purely on technicals. So that's the first reason why I believe that most retail traders really struggle and fail to be profitable, because they focus purely on technicals. And becoming a profitable trader using only technicals in the forex market, which is heavily macro driven, it's extremely difficult. So already just focusing purely on technicals, you're already increasing your probabilities of becoming a failed trader. So that's the first reason traders focus purely on technicals, and that's the main reason, to be honest. Sure, psychology is a problem, but most people don't even have an edge for psychology to be a problem, because if you don't have an edge in the market, no matter how good your psychology is, you're not going to make money. And most forex retail traders do not have an edge in the markets because they focus purely on technicals, and getting an edge with purely technicals is very difficult. So that's the major reason why I believe most retail traders really struggle. Now you may be wondering, okay, so I want to stop focusing purely on technicals now. So what do I do? What are the other factors that one should look at? And this is where my trading approach and philosophy comes in, where before I made this system right here, by the way, this is my trading system that looks at the main factors that drive the currency markets, and then aggregate all of this data to give a final bullish, bearish, or neutral reading. So this is the page that you're currently looking at the moment, that system I have developed to do this. So my approach to the markets is this. Before I developed this system, right, I was more of a discretionary trader, where I've always been a fan of fundamentals. So I've always asked a question: whenever I see movements on these candlesticks, I want to know, why is the candlesticks moving, right? And currencies are tied to real life fundamentals. Like, these aren't just trading currencies, GBP, AUD, GBP, USD. These aren't just fun little candlesticks on a chart that move about, and as traders, we're just playing a game trying to guess these candlesticks, right? No, these candlesticks are moving because of real life factors, because of things that are happening in real life, right? So knowing this, I ask myself, what are these real life factors that move this candlestick, that cause these candlesticks movements? And after doing a lot of research and just experience trading the forex market, I have come to realize that macro is one, seasonality, positioning, technicals. So I'm not neglecting technicals, I focus on technicals, and also yields, so the bond market. So these are the 5 main factors that drive price as it relates to currency markets. So whenever you're seeing these candlesticks moving up and down and sideways and all about, those movements are largely determined by either macro, seasonality, positioning, technicals, and yields. Those are the main factors that drive currency movement. These aren't the only factors, but I run a lot of backtests, and these are the most consistent factors that I've seen. Matter of fact, I'll show you a regime map. So this right here is what I call a regime map. So this is essentially, I run a backtest on my system, and the backtest is basically saying when my system is giving a reading of 55 or greater, make the background green. If it's giving a reading of 45 or less, make the background red, and anything in between is usual. So this is called a performance map, and we're looking at the performance map, my system's performance on GBP USD. And what you can see here is essentially most of the times the system is on the right side of the market. So my system is saying that macro, seasonality, positioning, technicals, and yields during this period was bearish. And what happened? GBP USD went down. Here it started to say it's bullish, it went up. If we zoom in even more on this, you can see that these fundamental factors, macro, seasonality, positioning, technicals, and yields, these tend to move very closely with price. So you can see the market goes up, the system is bullish. The market goes down, the system is bearish. So this means that these factors are closely, very closely tied to price, as my system shows. Even in 2025, we can look, this is the period of 2025. My system was bullish for most of 2025 on GBP USD. You can see that GBP USD, the price went up and up and up and up, right? So with experience and also the backtest that I've run on every single currencies, I've realized that these are the main and consistent factors. This is a backtest all the way from 2015. So these factors have been driving price since 2015. As mentioned, since the start of fiat currencies, these are the factors that drive price, right? First, I look at macro, and this is just the macroeconomic landscape in a particular country. So if I head to the economic data page here and we look at something like the United States, for example, we can look at things like the labor market, inflation, and growth. And then the system essentially scores all of this data using quantitative models. So in this is the latest economic data for United States. You can see that the labor market is about neutral. We had a big miss in NFP. Inflation mostly came in line with expectation, and growth, we had a beat in services PMI and GBP and a miss in ISM. So my system looks at all of this economic data out of United States and says for USD, macro is currently giving a reading of 48. So the macro in the United States is currently about neutral. This is what my system is telling me. And then it looks at things for like the UK, and you can see that most of the economic data out of the UK has been surprising to the upside. So my system looks at this. Let's look at GBP, and it says macro out of the UK right now is giving a reading of 59, which is essentially a bullish reading in macro. So my system is saying that macroeconomic data out of UK at the moment is very bullish. That is what my system is telling me at the moment. So that's the first factor that my system takes into consideration, macro. It simply looks at the economic data, and if we're surprising to the upside, this is usually a good sign for the currency, because it means that the central bank of a particular currency may raise interest rate, and raising interest rate is positive for a currency. So that's the first factor, macro. So sure, looking at technicals is important, but you also need to pay attention to macro. So that's factor number one. Next is seasonality, and currencies, they aren't really seasonality usually covers more of commodities and things like indices, so like S&P 500, gold, oil. Those are usually more seasonal assets. But for a certain months and certain period for certain currencies, I've realized that there's a pattern with seasonality. So I've developed a system that essentially it looks at seasonality for each month, and this gets updated every year, and it says based on this month seasonally is there statistical significance, meaning that based in the month of, let's say, May, we're looking at Australian dollar at the moment. My system has looked at the month of May for Australia and looked at the past 15 years of how the Australian dollar has traded in May, and it has said that on average in the past 15 years the Australian dollar has went down minus 2.35% in May, which is actually a huge huge pattern. And you can see a hit rate of 26%, and then you can essentially invert this. So 26%, it essentially means that this inverted would be 67%. So 67% of the month of May in the past 15 years has been negative for Australian dollar. So it is clear that in May, something happens in May that shows that the Australian dollar usually does not perform well in May, and my system reflects this by giving a score of 25 when May approaches for the Australian dollar, right? So that's what seasonality does. It looks at the 12 different months and looks at 15 years of historical data and see if there's any pattern with statistical significance, which is important. So it looks at the standard deviation to see if this has statistical significance, right? So that is essentially what the seasonality model does. That's the second factor that we consider here. So first is macro. So you're just looking at the economic data, see how the economic data is performing and what this means for a central bank. You're looking at seasonality. So how do currencies usually perform on specific months, right? Certain currencies like the US dollar tends to perform really well in September to November, and then it usually performs bad in December. So that's just a seasonal pattern, right? So that's the next thing that the system considers, seasonality. The next factor that the system looks at is positioning. What positioning does, it essentially gives you an overview of sentiment. So if I look at my positioning tab here, it essentially just tells you how asset managers, which is institutions, how they have been positioning, and you can look at certain look back. And because this is institutional positioning, so pension funds and hedge funds and all of that stuff, you know how big money, actual smart money, is positioning on the markets, and these guys tend to be on the right side of markets. So you can see that we're looking at positioning on USD, and they basically started to unwind their USD positions on January 14, and January 14 is exactly when the USD formed a high and started to head lower on the year, right? And in July, this is where the USD has bottomed out, and you can see that institutional positioning has actually started to build on USD since July. So these guys tend to be on the right side of the markets, and I prefer to use positioning more of a sentiment tool rather than like a buy or sell signal. So if people are extremely short the US dollar, right? So in this period right here, people were extremely short the dollar. So people were everyone was short and no one was long. This creates a chance of what's called a short squeeze, where the market just shoots to the upside aggressively because everyone was short and a lot of stop loss and all that stuff gets hit, right? So this is what positioning does, and this is how I analyze positioning. There's a lot more to it, but that's just a basic overview of how I use positioning. I usually like to use it as a sentiment tool. So when people are long but it's healthy, that's usually a good sign. It means that people are building long and they aren't overextended, and it's the same for a short. Whenever shorts are overextended, this is usually a sign of a reversal in the market. So that's the third factor that I look at. So I look at macro, the economic data, seasonality, how currencies usually perform in certain months, positioning, how institutions are positioning on the markets at the moment, and next we look at technicals. And the technical model is actually essentially a momentum model. So it just looks at momentum in the market. So if we're getting a strong technical reading, so this is AUD JPY is currently giving a reading of 66. So this means that AUD JPY has strong momentum at the moment. We look at something like GBP USD, the technicals are currently at 92. So this means that GBP USD currently has strong technical momentum, and if we look at the chart, it essentially reflects this, right? So the technical momentum on GBP USD has been going up. So that's what technical reflects in the market. It's very simple, very straightforward, right? It just reflects momentum. And next we have yields. And yields, the model here, it essentially looks at interest rate. So it looks at what markets are currently pricing in as it relates to interest rate. So interest rate is one of the main drivers of currency. When you talk about central bank policies and so forth, this is the main driver of currencies. If you look at the currency market on like a monthly time frame, and we look at something like GBP AUD, for example, you can see that for the most part, a currency like GBP AUD is just sideways. It just moves sideways for the most part. If you look at something like gold on a monthly time frame, you can see that gold is essentially just goes up over time. The S&P 500 is the same thing. It just goes up over time. But currencies, they mostly move sideways. And the reason why they mostly move sideways is because they're heavily driven by interest rate. So when interest rates are going up, this is usually positive for a currency, and you usually see a currency strengthen. And when it's going down, you usually see the reverse. So this is why currencies tend to move sideways, because they're closely tied to interest rates. And this is what the yield model looks at. The yield model says, well, for something like GBP USD, it mostly focuses on USD interest rate. So if, for example, right now yields, it's given a reading of 71 on GBP USD. So this means that the markets are currently pricing in a lot of interest rate cuts for USD. And if you look at the 2-year yield for USD on a daily time frame, what you can see is that this has been falling. So this essentially means that the market has been pricing in a lot of rate cuts for the US dollar, and this is what this model reflects. Yields being at 71% is simply telling us that the markets are pricing in a lot of rate cuts for the US dollar, and this is good for the Great British Pound. So this is why the Great British Pound is currently getting a reading of 71 at the moment under yields, because it is simply telling us that the markets are currently pricing in rate cuts for USD, which is good for the pound and not good for the dollar. So those are the 5 factors or indicators that I use to essentially get my bias on the markets. I look at macro. Again, this is the economic data. So labor market, inflation and growth. And I look at this for all the different currencies. So United Kingdom, Australia, Japan, all the currencies that I trade. The next factor that you have is seasonality, which again, you just look at the different months and how they perform over a certain number of years. And if there's statistical significance, meaning that there's a clear pattern for that particular month of how a currency trade, then the system will give you a bullish or bearish score that reflects this. And next you have positioning, which I like to use as a sentiment tool rather than like a buy or sell signal. So I look at positioning and I say, is positioning overextended? That increases the probabilities of a reversal. And if positioning is healthy, so positioning is long and it's healthy, then that's usually a good sign that you need to be on that side of the markets. And then next we have technicals, which simply looks at the technical momentum. So most retail traders' favorite indicator is technicals, which is usually the only thing they focus on. So if a market is going up, the technical indicator is going to reflect that there's positive momentum in that particular market at the moment. And then lastly, we have yields, which essentially looks at interest rate in a particular country. So it says that, hey, what is the market currently pricing in as it relates to interest rate? And these are the 5 different indicators that I focus on, and what most retail traders tend to ignore or neglect. Most retail traders do not focus on macro, seasonality, position, or yields. They only focus on this right here, technicals, which is why the failure rate is so high. So that's what I wanted to talk about today, looking at the markets from a broader perspective and taking into consideration other factors that drive price rather than technicals. And this is my approach. I'll be sharing the results and outcome and the performance of this at the end of the year. So stay tuned. Peace.